Hey guys, welcome back to the video. Today we're going to be discussing the first of the three primary business structures that company owners can think about forming when they're thinking about starting a business. So we have sole proprietorships, partnerships, and companies. Today we're going to focus on sole proprietorships. So yeah, let's get into it. Okay, so let's start off with a simple definition. So a sole proprietorship is a type of business which is owned and operated by one person. So yeah, the clear distinction between a sole trader or a sole proprietorship and a partnership is the number of owners. So a sole proprietorship can only have one owner. It cannot have more than one owner, whereas a partnership has two or more owners. So that's the sort of the main point of distinction between a sole proprietorship and a partnership. And then sole proprietorships are the most common type of business structure globally. They're preferred by small business owners because they're incredibly flexible, they're easy to get started, and they're very simple. You know, all you really need to do is start developing a product, start developing a service, and then start selling that product and service and generating revenue, and then you've kind of got yourself a sole proprietorship. There's not a whole lot of paperwork, a whole lot of red tape that's stopping anyone starting a sole proprietorship. So yeah, they are the most common type of business structure globally. So yeah, they dominate the global landscape in terms of different types of businesses. Sole proprietorships make up the majority of the different types of business structures that exist. Yeah, the owner provides the equity capital to get started with the business and to fund the day-to-day operations. And in exchange, the owner retains full operational control and ownership over the business. So yeah, the sole sort of entrepreneur provides the capital that the business needs to get started and invest in assets, and they retain the full control of any decisions the business makes. And yeah, like I said, they're the sole owner of the business. So yeah, they retain full operational control and ownership over the business. So one key feature, and I think this is really important to understand, one key feature of a sole proprietorship is that in the eyes of the law, there's no legal distinction between the owner of the business and the business itself. So in other structures that we'll come across, the owner and the business are seen as legally distinct. They're seen as two separate and unique legal persons, whereas in the sole proprietorship, that's not the case. The owner is seen as an extension of the business. So they're seen as one legal entity. And yeah, they're basically just seen as one in the same. If the business owes someone money, then the owner owns someone money. They're not seen as independent of one another. And yeah, sole proprietorships, as I've already sort of alluded to, they're referred to sole traders in many jurisdictions. In the US, they're known as sole proprietorships, so that's how the curriculum refers to them. So typically, because sole proprietorships are typically small businesses, the owner is involved in the day-to-day operations. So they're heavily involved in, you know, the mechanics of the business. They get up early. They're involved in producing the product, selling the product. And they have full control over management selection. So if they want to outsource management responsibilities for the business, they have full control over that. And they get to participate entirely in the business's financial returns and risks, as they are the sole owner. So yeah, because there's no one else who sort of participates in the ownership of the business, the upside to the sole trader is that they're exposed to 100% of the financial return. So if the business does well, they make all the profits, and they're exposed to all the upside potential. But they're also exposed to the downside, right? So if you're 100% owner and the business underperforms, then you're on the hook entirely. You've got no other partners or other shareholders to sort of share that risk or share those losses with. You have to bear those losses sort of entirely yourself. So yeah, so you're entitled to 100% of the upside if the business does really well and smashes it out of the park. but you're also exposed to 100% of the risk and the downside if the business underperforms and makes significant losses. And yeah, you'll be personally responsible for repaying the business's debts if the business is unable to fund them, but we'll discuss that a little bit more on a subsequent slide. And then tax. So from a tax perspective, the profits that the business generates are passed through straight to the owner. So this is what is known as a pass-through taxation structure. So the business itself is not subject to any tax. So it's not subjected to corporate income tax or corporation tax, as it's known in sort of certain jurisdictions. And this is known as a pass-through taxation structure. So the business doesn't pay any taxes, but the owner pays taxes at their personal income tax rate on the business's profits. So the owner of the business pays taxes on the business's profits themselves, but the business does not pay taxes. So there's no corporate taxes due, there's only personal taxes due by the owner on the business's profits. So a little bit confusing, but you'll see when we get to corporations there's a bit of a contrast, because corporations, public limited corporations, are subject to double taxation, where the business pays taxes and then the owner pays dividend taxes on any distributions that are made. So that's kind of the distinction. But yeah, for sole proprietorships, the profits are just passed through, and the owner pays personal income taxes on those profits. Right, so now let's start to think about advantages and disadvantages. So the key advantage of a sole proprietorship is its simplicity. It's very easy to get started, there's little paperwork, and there's very little in terms of restrictions in place. And it's also a very cheap structure to form. It's low cost. Like I said, there's low disclosure requirements. There's not much in terms of regulatory filings that need to be made. So yeah, it's a cheap and simple form of business structure. So very easy for sort of new entrepreneurs and small business owners to use as their sort of foundation. Now, the main downside of sole proprietorships builds on the point around the law seeing the owner and the business as one entity, and that is that the owner has unlimited liability. And this is really, really the crux of it. This is really important, so I'm going to underline this twice. So yeah, the owner has full and unlimited liability for any of the actions and debts of the business. So the owner is personally liable for any financial obligations undertaken by the business or losses incurred. So basically, to explain that in a nutshell, if the business makes losses or takes on debts that it cannot pay, then the creditors, if they can't go to the business, they're going to go to the owner. So if the business can't pay its debts, then the owner will have to sort of offer up its personal assets and pay those debts using their personal assets. So, you know, if the business can't pay its debts, the owner may have to sell its home, the owner may have to sell its car, the owner may have to take their kids out of school and pay the debts using their own personal money. So that is a key and really important distinction to be aware of when it comes to sole proprietorships. The business and the owner are one and the same. If the business can't pay its debts, then the owner becomes liable for those debts and may need to sell their personal assets, such as their home or their car, to fund those liabilities. Okay, so let's just do a quick sketch, just to make sure we're completely clear how this structure works. So we have an owner, so this is a single owner, so you can't have more than one owner in the business. And then you have the business, so the sole proprietor. Sole proprietorship. And by setting up the business, the owner has 100% control and ownership rights over it, but they also provide unlimited liability to the enterprise. But yeah, what the owner receives in exchange for that unlimited liability is complete control over the business and ownership over operations. So yeah, the owner has to sacrifice their liability and has to put up its personal assets as potential, there's a risk that they may lose its personal assets from undertaking a sole proprietorship, but in exchange they are the sole owner. They have complete control over all decisions the business makes, and yeah, that's kind of sole proprietorships in a nutshell. Okay, more downsides. So sole proprietorships are severely limited in how much external financing they can raise. As by definition, they have one owner. They cannot bring on board more owners, so you can't add additional partners. Obviously, that would become a partnership. So they can't bring on board any more owners to sort of inject equity capital into the business. So there's no additional sources of equity capital. They can't bring on board any more owners. And then from a debt perspective, they're limited by the owner's personal borrowing. So their borrowing capacity is how much debt that individual can borrow from a bank. And to be quite honest with you, the amount that individuals can borrow from banks is pretty low. So they're very limited in terms of their access to financing. Effectively, they can really only rely upon the amount of cash the owner holds personally and their borrowing capacity. Once these two sources of funding have been exhausted, there's really little but much more that the business can do in terms of raising sort of capital. And they're also restricted by the risk appetite of the owner. So if the owner has a low risk tolerance, they could end up holding the business back from exploring and engaging in profitable investment projects and opportunities, and they may sort of hold the business back from fulfilling its true potential and realising and sort of profiting upon exciting forward-thinking growth opportunities. So yeah, they can hold the owner can end up holding the business back if they're too risk averse. And then just some final points here. In many jurisdictions, sole traders are the default organisational structure. So if you set up a business, you will by default be setting up a sole proprietorship unless you specify otherwise. No legal registration required, and the business is dissolved when either one of two things happens. One, the owner no longer wants to be involved within the business, or when they die. And common examples of sole traders include family-owned businesses, so very small sort of family businesses where the owner deploys their personal savings or takes out a small bank loan to kickstart the business. So yeah, it's very small, sort of, maybe one owner, a couple of employees, that sort of size business, pretty small. And yeah, my final point that often kind of what often kind of creates confusion for candidates is that sole traders can hire employees. So just because there's one owner doesn't mean they have to do it all by themselves. They can hire people to work underneath them and support the business, but there can only be one owner. That is really important just to be clear on. So there can be sort of multiple employees working within the business, but just one owner. There cannot be more than one individual that has a sort of stake or ownership stake in the business. So you can have employees, but just one owner. So yeah, that's all I had. Hopefully that was helpful. Sole proprietorships, need to be thinking about what they are, what unlimited liability means in terms of the responsibilities of the owner and what they could be liable to if the business fails. The taxation of a sole proprietorship is important, how that differs to company taxation, which I'll come on to on a separate video. And the pros and cons, so the simplicity of setting up versus the risk tolerance of the owner holding the business back, or the limited access to capital. So yeah, just be aware of those things. easily be tested in an exam scenario. And yeah, I'll start to cover partnerships in the next video, so stick around if you want to learn a bit about the different partnership structures. So yeah, any questions, fire them off in the comments. I'll see you guys in the next video.